What is up, you guys? The markets are closed for the week of August 26, 2022, and the S&P and all the major indexes are down huge. No stock has had a worse day than 3M, ticker symbol MMM. 3M is an industrial conglomerate and a dividend king, having raised their dividend for over 63 consecutive years. 3M products are in all of our homes. They're a fantastic company, but things have not gone well over the last few years, and the current stock price is sitting right around the same levels as it was 8 years ago. So is 3M currently a buy? Let's take a look. This is the Dividend Growth Income channel. We are all about investing, and in particular, we like high-quality dividend growth stocks. I'm Nick. Thank you for joining me today for a quick valuation of this highly respected dividend king. Please keep in mind I'm not a financial advisor. I'm just a guy who loves dividend stocks, and this video is just for entertainment and educational purposes only. Buying into the stock market is risky, so please do your own due diligence. 3M is in the news once again today. We're down nearly 10%. Year to date, the stock has been beaten down 27%. The company has been a very highly regarded stock with dividend growth investors historically, and for good reason. 3M was delivering above average dividend growth consistently for many years, but over the last few years, dividend growth has slowed down. The average compound annual growth rate of the dividend for the last 20 years is 8%, but last year the dividend growth increase was a pathetic 0.7%, so it's really dropped off. The dividend does look reasonably safe. The payout ratio is around 60%. Simply Safe Dividends reaffirmed its safety score of 75, just safe, on August 19th of 2022. Now just a quick look at a few things. While revenues have grown somewhat over the last few years, it's not been particularly consistent or impressive. They have been buying back shares, which we do like to see. Now, I don't own this company, guys, in my portfolios. And while I like the company, I follow the news around it, 3M has just not been high enough on my watch list just because I have a limited amount of capital to spread around in my investments. And as I'm primarily a dividend growth investor with a long time horizon till financial independence, 3M just doesn't really have the qualities I'm looking for my investments in general. Now, a lot of you guys are 3M shareholders, and if you're holding on through this turmoil, much respect to you. I'm making this for you guys. So before we do evaluation, we do have to mention the lawsuit, and this is really why the company is down so hard today, in addition to all the other bad economic news from Jackson Hole. 3M had a defeat in the courtroom when it lost an effort to block more than 230,000 lawsuits brought on by American soldiers that alleged defective earplugs did not work as expected. We don't yet know how this is going to play out. These lawsuits are troublesome, no doubt. But look, 3M has been at this for 120 years now, and they've survived world wars, pandemics, recessions, high inflation, and I'm sure many lawsuits. If you believe in the future of 3M, this could very well be a great buying opportunity for a value investor. What we hope to see are settlements as soon as possible, figure out the damages, and get out of court. The sentiment I'm seeing in the comments section of Seeking Alpha towards 3M is very poor today. Lots of folks are talking about selling, and I'm reminded of a famous Warren Buffett quote, "Be fearful when others are greedy, and greedy when others are fearful." So let's determine a fair value for 3M shares. Now, all valuation models have their pros and cons, and none are perfect. What I do is I take the average of 6 different valuations to estimate a fair value, and then I apply a margin of safety based on a few variables I determine, such as dividend safety, the mode of the business, and its future outlook to determine the buy price. And I'll also consider things like lawsuits that are facing the company. Now, there are 6 valuations that I use. I use Graham's revised model, and I'll throw that up on the screen. I use a dividend discount model. It's also known as the Gordon growth model. A discounted cash flow valuation, a dividend yield theory valuation, a PE mean revision valuation, and then I'll also get the analyst's average price target. So the first 3 models there are dependent on various inputs based on what we think the future growth rates are for the company. And these models can vary drastically based on this input and the discount rate chosen. And the 4th and 5th models are relative valuations based off 5-year historical data. These can be very useful if we believe in the overall future of the company and the fundamentals. However, if there is a reason to believe the fundamentals have changed, then they may not be particularly helpful. But that's why we take the average of all of it together. So here's what I got. I built out this little valuation tool in Google Sheets so I can show it all on one screen nicely. The light blue fields are where I have to add my inputs. First, we have our stock ticker, 3M, and its current share price of $129.14. Its current annual dividend is $5.96 for a yield of 4.62%. So for folks who are looking for current income, this could be an attractive income play. I've entered a forward PE PE and a forward earnings per share of 12.2 and $10.60 respectively. For Graham's revised valuation, I'm using a growth rate of 4.6%, which I got from Yahoo Finance. And this is current yield of AAA bonds is at 3.93% at the time of publishing this video. Estimated fair value using Graham's revised valuation is $137.67. Now for my dividend discount model valuation, I'm using a dividend growth rate of 3%. And that's assuming that during the lawsuit, dividend growth is going to remain understandably slow. And then when they come out of it, they may potentially have the ability to begin raising this dividend again once more. Now using a 9% discount rate, I'm getting a fair value of $104.42. Now if I were to use a dividend growth rate assumption of say 5% growth, then we're looking at $156.63 for a fair value. So just changing these growth rates can really moves these knobs. I want to be conservative in my guesses here. And given the current landscape of 3M, guys, I'm not even sure 3% is conservative enough. If you look at their last few dividend raises, they're doing the bare minimum just to keep their dividend king status. Now, for my discounted cash flow valuation, I've used a 4.6% growth rate and a perpetual growth rate of 2.5% and the discount rate of 9%. Now, adding in their free cash flow and their shares outstanding, currently this gives us a fair value of $128.48. This model in particular changes drastically with just small adjustments in the input. Now, 3M's historical 5-year dividend yield is 3.29% compared to its current dividend yield of 4.62. Now, if this were to revert to the mean, 3M would be valued at $181.16. 3M is trading at a PE of 12.2, and this is well below its 5-year average of 18.7, giving us a PE mean revision valuation of $198.22. Now, the average analyst price target, that's $149.11, and the analysts are all over the place on this one, guys. $118 on the low side to $210 on the high side. So putting all of this together, this gives me an estimated fair value of $149.84, meaning the current price for 3M is potentially 16% below fair value if you believe my estimates here. Now, of course, further due diligence is needed. I could be way off on my numbers here. I do like that I came in right at the same place where the average analyst price targets, and I think that's pretty interesting. Now, given the challenges facing 3M and the very slow dividend growth, I really want a higher margin of safety around this one than average because I'm just not that interested in it. There's no question the stock has become a dog in the market, and there's certainly a lot of risk here. Now, I'm going to go with a 30% margin of safety. This gives me a target buy price of about $105. And if we think things may have fundamentally changed and decided to take out those relative valuation metrics, our fair value drops even more to $129, and this would give me a buy price of $90. So this one would have to come down another 20% or so for me to consider starting a position. I see way too many better opportunities out there for investors, and especially dividend growth investors. And I do think in a few years this lawsuit's going to be a thing of the past and 3M should come out ahead. And if I was already in this one, guys, I wouldn't be selling it and I'd probably be adding more to my position. But I'm not in it, so I'm looking for more in terms of dividend growth and total growth, really. I do think for a value investor looking long term, this could be a very interesting play. You get about an 8-year low. It's just not for me at this time. I am going to be paying attention to the lawsuit, what goes on with 3M's business, and I'm open to changing with the when facts change. So thanks for watching, guys. I hope you found this useful. Let me know down in the comments what you think and what you're doing with 3M. Are you a shareholder or are you like me, just watching on the sidelines? If you enjoyed this video, I can ask you to please give me a like and subscribe to help me grow my little channel here. Also, please check me out on Twitter at DivGrowthIncome. I really enjoy talking stocks and dividends with like-minded investors. So guys, more fun stuff is to come on dividends and investing in general. So until next time, keep investing.